me share screen. Okay. All right. Well, welcome everyone. Thanks for coming out today and joining us for our 90-minute training session. My name is Frank Webster, and I am a business development officer for Virginia Housing. And my job is to go around the western part of the state, what we consider to be an underserved area of the state, and promote home ownership, affordable home ownership, by using Virginia Housing programs. So I deal with realtors. I love working with realtors, lenders, nonprofit organizations, local governments, just to make everyone aware of what we do and how we can move the needle in bringing down the cost of home ownership and opening the door more widely so more people can take an opportunity, take the advantage of the opportunity of affordable home ownership. So I've been doing this for 5 years now. Before this, I was a mortgage loan officer for 35 years. So my whole career, the last 40 years, all I have done is work with home buyers, worked with realtors, and done everything that I could in the trenches, on the front lines, to help promote affordable home ownership. And so I hope that what I'm going to share with you today will create an awareness on your part of some of the tools that are available that you can use to help experience higher levels of success for yourself. Of course, we're here to help promote home ownership, but we also know that we want to promote your success. So we want to help you sell more houses. We want to help you increase your income, because your success really is essential to us. We won't be successful at Virginia Housing unless you're being successful. And I know, I say as an aside a lot of times, if you want something done, bring realtors in. Because realtors always find a way to get the job done. And I know that, having worked with you guys for the last 40 years. So let's go ahead and dive into kind of an introduction to Virginia Housing. How many of you have heard of Virginia Housing before? Raise your hands. That's good, 100%, just about 100%. Now, we just changed our name a year ago. So many times when I ask that question, half the hands in the room do not get raised. And they look at me, people look at me with a blank look like, no, I've never heard of Virginia Housing. Who are you? So before we were Virginia Housing, we were VHDA. So more people know us by the name VHDA than they do Virginia Housing. VHDA stood for Virginia Housing Development Authority. We rebranded ourselves last year and changed our name to Virginia Housing. Really, the only reason we did that was that we wanted a name that would better represent, or can represent our values and our mission and our purpose to our stakeholders, to our business partners, to our clients, and everyone who gets the benefit of our programs. Other than that, we really didn't change anything when we changed our name. We are in our 50th year of existence. So we've been around since 1972. If you see any of our advertising in different mediums, you'll see a big deal being made about our 50 years of existence. So I would say no one in the state of Virginia, no entity in the state of Virginia has done more to promote affordable home ownership than Virginia Housing. And everyone, when there's a discussion going on about affordable home ownership, everybody wants us at the table. We're probably the most influential state organization that there is when it comes to promoting affordable home ownership. And I think it's really interesting to tell you at this point, at least I get told all the time, emphasize this. This is really important to people. We don't get any state taxpayer money. So we're not using your taxpayer money to do the programs that I'm going to tell you about today. We are self-sufficient, we're autonomous, we're basically a mortgage company that raises our own revenues. Anything that's left over, what you would call a profit, but in our world, we call it excess revenues. We put that back into the housing market. We put a significant part of that money back into our programs to help further our mission and to finance all the things we're going to be talking to you about today. So there's the slide about the rebranding. We were VHDA for 49 years. We're now like in our second year of being Virginia Housing, but that's that's consistency and continuity there. It's 50 straight years of being a great force in the Commonwealth to help promote affordable home ownership for everyone. So let's talk about, I'm going to give you an introduction here, a high level introduction to what Virginia Housing does and why we matter. Why have you taken 90 minutes of your time today to come in and hear about Virginia Housing? So basically, we're a mortgage company. That's the best way. That's the best way to think about us. And so we're a mortgage company, and you're going to get to, but you're not going to have to change your allegiances to loan officers. We don't have loan officers that you call on to do our loans. You're still going to get to use your local lenders. So we have two of them here today. If you want to use these programs, you don't have to call me. You can call them and they would be happy to help you. So you're going to use the same lenders that you always use, and you're going to use the same programs that you're used to using. There is no such thing as a Virginia housing loan per se. When you deal with your local lenders to access the things that we're going to be talking about today, you're still going to be financing your properties through FHA financing, USDA financing, conventional financing, and VA. And in every respect that the loan that the borrower is going to be receiving is that loan. And 90% of the rules that you need to know about when you're using our programs are going to just default back to what does that agency say about a particular matter or a particular topic. So there's a lot of familiarity there. We're not asking you to move the cheese, or to move your cheese, or to move out of your comfort zone. Use your same lenders, use your same programs. But then what Virginia Housing does that's different, and where we add real value to the transaction for the home buyer, for the lender, for the realtor, is that we have what we call specialty products that we align with the agency loans that you do. And each specialty product that we provide basically is a solution to a problem that is an impediment to the home buyer. That's either delaying them from being able to buy a house or preventing them from being able to buy a house altogether. So I would say these specialty products would break down into three different main categories. One would be down payment and closing cost assistance. The number one problem, the number one challenge that home buyers have to get into a home is how do they come up with the funds for closing? They have good jobs, they have good income, they have good credit, but boy, they just can't come up with the funds that they need for closing. So Virginia Housing offers a significant amount of down payment and closing cost assistance. We'll go into more details about those in a bit, but 97% of everybody that gets a Virginia Housing loan gets some form of down payment or closing cost assistance. And that's an incredible resource to plug into the mix for your home buyers. The second challenge or impediment that home buyers have is they're payment conscious. I mean, they always have been, but now maybe more than ever, because house prices have still been going up. Now interest rates are going up too, to the highest levels they've been at for a couple of years. So everybody's looking for a break on how can they make their payments be lower, either for qualifying purposes or just to feel comfortable with them. So we have a couple of different ways where we can lower the borrower's mortgage payment. We have ways where we can lower the interest rate, and we have ways where we can lower the cost of the mortgage insurance. All of that translates into a lower monthly payment. And then the final category that we help the borrower with is with their federal income taxes. We have a way where the borrower can have or pay a lower federal income tax liability every year for up to the entire 30 years of their mortgage. And when they lower their tax liability, it's also going to increase the amount of their refund. So we've covered all three bases. We're going to get them into the house for less money. We're going to help them have a lower monthly payment, and we're going to help them with their taxes. If I told you your borrower could pick out any one of those things and that they could use that to help get into their house, everybody would think that would be really great, and that would be really a blessing. But you don't have to pick one. Instead of just picking one, a lot of times your borrower is going to be able to pick all of them and get every type of those benefits on the same transaction. And when the borrower can leverage that way and they can take advantage of all of those benefits, it really is going to lower the bar and open the door of opportunity much wider, so more people are going to be able to get into their first homes. So before we go into the actual talking about the programs and the strategy of how you can use these things to get a borrower into their home, I need to talk to you about eligibility and qualifying for the loans. So there is a difference between eligibility for a Virginia housing loan and qualifying for a mortgage in general. So every mortgage that you get, whether it's from Virginia housing or not, the borrower has to qualify. And qualifying, these fine lenders here would tell you, they would look at the borrower's income. Is it sufficient? Do they have good credit? Do they have some cash in the bank? Do they have some liquidity there? And then we would look at the collateral, which is the property too. We'd look at the appraisal to make sure that everything is suitable and would be within risk tolerances. So the borrower does still have to qualify for the loan when they're getting something from Virginia Housing. But in addition to that, the borrower has to meet certain eligibility criteria. So there will be times where your lender could say to you, your borrower qualifies for a loan really great, but they're not eligible for Virginia housing because of ... So I'm going to introduce you to a couple of those things so that if your lender says to you, they qualify for a loan, I'll qualify them for a $500,000 house, but they can't get Virginia housing, then you've heard it from me. You'll kind of understand the lingo. You'll understand why they're saying that, so you can relate to them a little bit better. So the number one eligibility criteria that we have is that for the most part, with very few exceptions, the home buyer has to be a first-time home buyer. So we have a unique definition of being a first-time home buyer. More people will be first-time home buyers than you would think. So our definition of a first-time home buyer is it's a person who has not had an ownership interest in their primary residence within the last 3 years. So I'm going to emphasize two parts of that definition. One is we're only looking at the primary residence as a trigger there. So somebody could have owned real estate or even own it presently, and as long as they hadn't lived in it and used it as their primary residence in the last 3 years, we would still consider that person to be a first-time home buyer. One of the best examples of that would be somebody who's owned rental property. As long as your borrower has not lived in that real estate in the last 3 years, then we would consider them to be a first-time home buyer. And then the other neat part of the definition is that we only look back 3 years. There's only a look back period of 3 years. So somebody can become a first-time home buyer multiple times in their adult life. If they could own a home, live in it, use it as their primary residence, all they have to do is be out of that house. They don't even have to sell it. They just have to be out of that house for 3 years. And then on the first day of the 4th year, they're a first-time home buyer all over again. So you do have to be a first-time home buyer, but it's very nice to know that more people are first-time home buyers than you might have otherwise have expected. So the next big thing with eligibility for Virginia housing loans is that we have maximum income and maximum sales price limits. So the borrower cannot make more than a certain amount of income, and they cannot make more than they cannot buy a house or purchase a home that has more than a certain sales price. But again, even though there's limits, you'll be surprised at how high those limits are, and there are loopholes that you can use to exploit that make it even better than you would think. So we're going to talk about those on the next slide. All right, so this is your income and sales price table. You can also find this on our website at virginiahousing.com. And you can refer to this. So the first thing that you need to know, if you've never looked at this table before, is what area is the property located in? You would have to go way, way, way far out of your footprint to find anything that other than all other areas of Virginia. So unless you're going to go and sell a house in Charlottesville or Northern Virginia or Hampton Roads, then every transaction that you're going to be doing in this area, whether it's Lexington, Roanoke, Salem, Blacksburg, Christiansburg, Wytheville, go over to Lynchburg, go down to Martinsville and Danville, anything in this part of the state, you're going to be in all other areas of Virginia. Okay. Then when you go to the middle section of the page, it says maximum gross household income. And underneath that, there's two choices. There's 2 or fewer people, or there's 3 or more people. Everybody see that? Usually, if I wasn't in front of this camera, I'd be all over the screen and I'd be pointing and everything. So I've been chained down to the podium, so I can't do that. So I just have to give extra good instructions verbally so that you can follow me on this. So you're going to look for the household size, the number of people who are in the household. How do you do that? You're going to count the actual number of people that live in the house, even if they're not on the loan, even if they're not on the title, even if they're a minor, even if they're a child. You count the total number of people who are going to live in the house. And you'll see there that the larger households will have higher income limits than the smaller households. So a family of 3 or 4 will have higher limits for income than a family of 1 or 2. Then underneath that, under the choice about the size of the household, you're going to see 2 boxes. It says, one says standard and the other says with Virginia Housing DPA or CCA grant. Let's see if I can use the pointer here without messing everybody up here. I can do it a little bit. Okay. So you're here at all other areas of Virginia. See that? Okay. And then you're going to be doing your size of the household is right there. And then you have standard where you have grant, and then that's duplicated over here. Okay. So if the borrower is getting some form of grant from Virginia Housing, and grant is free money from Virginia Housing with no strings attached. It never has to be repaid. It's going to fall under the grant column. If it's not free money, if it has to be paid back to Virginia Housing, it's not a grant, and that's going to fall under the standard column. And you'll note here that the grant column has lower income limits than the standard column. So the grant limits are going to be lower income limits. The standard is going to be higher limits. So if you go down to the bottom of the page, let's say you're in Roanoke, all other areas of Virginia, and you're going to do a family of 3. Let's say it's 2 adults and a child, and they're going to get the standard limits that says $110,000 is the limit. That would be the maximum income of the borrowers on the loan. So you could have combined income for those on the loan of $110,000, which is pretty generous. And if you have, and since you're only counting the income of borrowers on the loan, if you have a household income where the two people are making more than that, like $150,000, if you can remove one person from the loan, you can exclude their income from the calculation. And if the remaining person fits within that limit and they can still qualify for the payments completely on their own, they would still be eligible to get a Virginia Housing loan. So in that case, you've got a limit there of $110,000. If you have a husband and a wife, or any 2 adults that are buying the house together, they could be making $200,000 or $300,000 or $400,000 a year. And if your loan officer can remove one borrower and make it so that the remaining borrower's income falls under that limit and they can qualify for the payments, that borrower is still going to be eligible for no money down financing from Virginia Housing. So income limits, but because of the way we do that, more people are going to fit into our income limits than you might have otherwise expected. Now you can do that under the standard column. And when we get talking about the different benefit programs, the second mortgage, which is our most popular program, that falls under the standard column there, the standard limits. When you're doing the grant program, which is free money, the borrower doesn't have to pay that back, that's going to fall under the lower income limits. And if you're doing the grant, you have to use the income of all household members. You can't do the little maneuver or the little trick that I just told you about. So if you're doing a grant, like a down payment grant or a closing cost assistance grant, even if you took somebody off the loan, even if you took them off title and they had nothing to do with the transaction at all, you'd have to count the income of all household members towards that limit. You do it a lot like the way that lenders do USDA financing right now. So more people are going to be eligible to get the second mortgage than the grant because you're going to have higher income limits that are available to get the second mortgage. You don't have to remember all that. All you have to do is have a great loan officer. Do we have any great loan officers in the room? We do. So they do the heavy lifting. I'm just introducing this to you so you'll be able to discuss it and be fluent in talking to them about it. But the lender that you choose to work with is the key to the whole thing. They do the heavy lifting, and they've gone through this many more hours of training than you guys have to get your credit today. The other thing that we have is a sales price and loan limit. So if you look at all other areas of Virginia, it's $330,000. That means that the sales price in your contract cannot be more than $330,000 to be eligible for Virginia housing. It also means the loan amount cannot be more than $330,000. And there's going to be some rare occasions where the loan might be higher than the sales price, like on a VA loan or a USDA loan where there's a finance guarantee fee or funding fee that could potentially put the loan higher than the sales price. And in those cases, the loan amount or the aggregate of all the financing cannot be more than $330,000 either. So just remember, there's income limits, there's nuances to that, there's sales price limits, there's loan limits, and you don't have to have a PhD in finance. We're not converting you into loan officers today. Just work with a great loan officer and they'll do all the heavy lifting. They're just going to come back to you and say, here's your pre-approval letter. If they're going FHA, and here's what the payments are going to be. Here's what the closing costs are that you might need to ask for and such. And that's all you're really going to have to do. Did you have a point or question, Paul?
Yes, can you address on the grant side when there is family members that are employed that typically a loan officer or a realtor wouldn't even think about, that we have to consider their income? For example, grandma who's retired who lives with them, or a significant other or something like that.
Yeah, so what Paul is pointing out is something I sort of alluded to. If you're doing a grant, you have to use the income of all household members, and you might not be thinking about like the fact that their elderly parents live with them, or that they have, or that she has a roommate or he has a roommate or something, and that they even share checking accounts and savings accounts and stuff like that. So if you're getting the grant, you have to be careful. I mean, you don't, the loan officer does. You have to be careful to make sure that you're including the income of all household members. If you're not doing a grant, and if the second mortgage is not a grant because you have to pay it back, you don't have to do the same thing. With the second mortgage, you only have to use the income of borrowers who are on the loan.
And the reason that I bring it up is sometimes the realtors have a little more knowledge than the loan officers do, because
Right.
they've spent so much time with them.
Right.
And we hate to uncover this 10 days before closing. But if you've already know it, it's great to share it with your loan officer.
And another point to make about that is you have to use, for anyone that you have to count their income, you have to count all of their income, even if they don't need that income for qualifying. And even if they can't use it for qualifying, you still have to count it towards the limit. So if somebody has only been getting overtime for 3 months and you can't use that for qualifying, you still have to annualize that overtime income and count it towards the limits. If you have somebody that, they have so much, their base salary is sufficient to qualify and they're not using the overtime for qualifying, you still have to count the overtime towards the limits to make sure that you don't go over or exceed the limits. Do you have a question from the audience?
Actually, Laura has a Zoom question.
Okay.
Laura,
You're on mute.
you're muted.
Fine.
Laura.
Laura
Oh.
muted.
You can read it. It looks like it says that would be the same for someone with bad credit.
Laura, if you could unmute yourself.
I just told her she's muted.
Hi, yes, I was just asking, so that would be the same criteria for someone with bad credit? As to, you still have to count the income even if they had bad credit?
If it's a grant, you would. If it's a second mortgage and they've got bad credit and they're not on the loan, then you would not.
Okay, so going back to the first one with the grant. So if there was, because I put another another question in there. So if the end price ended up being more than 330, do they just cap it at that? And then the buyer would have to come up with the difference in the monies?
No, it's an absolute limit. So if
Okay.
the sales price is 331, they can't just finance 330 and cover the 1,000 on their own. If the sales price is 331 or 330,001, then they simply would not be eligible for Virginia housing financing.
Okay. Thank you.
You're welcome. Thanks, Laura. All right, everybody got that? Everybody in the room got these concepts about the income and the sales price? And Laura, everybody on the call, they're good? No more questions?
No, we're good.
All right, very good. Okay, so now we're going to dive deep into the options. So this is kind of, I've already said this once, but sometimes hearing it multiple times, it sinks in and you understand it better. When you're dealing with Virginia Housing, you're not going to call me. You're not going to call anybody at Virginia Housing to take advantage of the programs that we're talking about today. Who are you going to use? You're going to use your local lenders. We have 90 different companies that represent us in the different markets across the state. You can talk, you've got a couple here that are great. You can call and talk to me about who you want to use if you don't have one now, or you can go on our website and there's a find a lender tool there where you can look up and see who are all the lenders that are approved to do business with us. So you get to use who you like, who you're used to using, who you have a comfort level with already, and you're going to still get to use the same loan programs that you're used to using. So sometimes someone will say, I'm really freaked out about doing a Virginia housing loan. I don't do new things very well. It kind of spooks me. But I would just say, or if you're used to writing contracts with FHA financing, then you're 90% of the way there already. You're already an expert because 90% of what you need to know is going to correlate to what FHA says, or 90% of what you're going to be doing correlates to what USDA says on a USDA loan or conventional on a conventional loan. So if you're good about writing contracts and checking the boxes and filling out the sections pertaining to the different types of financing, nothing changes when you're using Virginia Housing. A conventional loan is a conventional loan, an FHA loan is an FHA loan. And your lender is still going to choose the program that they have determined is going to be the best fit for your borrower. If Paula thought, conventional is the best way to go, or FHA is the best way to go, then they're still going to use that. And then we're going to align these specialty products with the loan so that the borrower gets the most help that they can, and they can take advantage of all the resources that we have to plug into the transaction to help them get into the promised land or get into their home. So let's talk about the conventional loan just for a moment. We do all the different loan programs. So we do FHA, we do USDA and VA, and those loans are just flat out, that's what they are. A VA loan is a VA loan. A USDA loan is a USDA loan. But our conventional loan has a couple of features that pertain to the mortgage insurance, the PMI. And with our PMI on our conventional loan, this is going to lower the upfront cost of the transaction significantly. It's going to lower the monthly payments that the borrower has to pay. And it's also going to give them the opportunity to get out of their private mortgage insurance, because FHA mortgage insurance never ends. Conventional mortgage insurance does terminate usually 7 to 10 years down the road when the loan drops down to 80% of the value of the property. So by looking at our conventional loan, we can really drive down the cost of home ownership and the cost of the mortgage. I'm going to show you some examples of that in just a second. So when you start out with our conventional loan, we start out by saying your borrower has to put 3% down. 3% is the minimum down payment. That's lower than FHA, because FHA is 3.5% down. But we are going to then make down payment assistance available to your borrower. The grant would lower that down payment from 3% to 1%. So you could get a conventional loan with 1% down. The second mortgage would, if you align that with the conventional loan, the borrower can get in for 100% financing, and the borrower would not have to put any money down. So that's, some good options there for getting the borrower into the property for the least amount of money out of their pocket. The bullet point there that says qualifies for MCC, MCC stands for Mortgage Credit Certificate. It's a tax break that we provide to first-time home buyers that will help the borrower on their federal income taxes. We have a market interest rate. So the interest rate on this loan is not going to be higher than the market. It's going to be right in there with what all the lenders are charging on conventional loans. Then we get into the mortgage insurance piece. And with the mortgage insurance, we're going to be saving the borrower a lot of money. So if you look at this slide here, this is a comparison on a $200,000 house, and the borrower has a credit score of 720. So if the FHA generally is going to have a slightly lower rate than compared to conventional. And if you chose your loan program based on interest rate, everybody would just go to FHA. But then you're going to see on this example that if you do that, even though the borrower would say, give me the lower rate because that's going to save me money, they're actually going to pay a lot more money going FHA than if they had gone conventional. So if you look at this, my annotation back here. On an FHA transaction that's $200,000, FHA charges a very large, high upfront mortgage insurance premium of almost $3,400 to anybody, to everybody. It's 1.75%. Whereas if you shifted them over to conventional, the conventional would have a slightly higher interest rate, but immediately they're going to save that upfront mortgage insurance because it's not charged on a conventional loan. So right out of the gate, you've saved the borrower like $3,400 by having them go conventional instead of them going FHA. Now, again, you would think with that lower interest rate that would translate to a bottom line where the borrower's monthly payment would be lower by going with the lower interest rate on an FHA loan. So the payment on that FHA loan at 7.25 was $1,701, but the conventional with the slightly higher rate of 7.5, it actually ends up having a lower monthly payment by about $80 a month. And so you might say, well, how could that be? If the interest rate's higher, how could that give the borrower a lower monthly payment? It all has to do with this line here, the next to the last line on the slide, the mortgage insurance, the monthly mortgage insurance. You can see that FHA, not only do they charge that upfront premium that's really high, it's $136 in this example. Conventional is only $56 a month. There's a difference there that is so great that even with the higher interest rate that you have on the conventional loan, that reduction in the mortgage insurance is going to lower the borrower's mortgage payment like by $80 a month. So for the first 10 years, the borrower is going to save $80 a month by going conventional. And then the spread would get even wider because at the end of, say, 7 to 10 years, the monthly mortgage insurance of $56 will terminate. It will come off altogether. And then the borrower's payment is going to drop down to less than $1,600 a month. So the spread becomes even wider. I did a calculation, and if you just look at the first 10 years of the transaction, if you include the finance mortgage insurance you're saving, the higher monthly premiums that you have, for the first 10 years, the borrower would save like $14,000 by going conventional instead of FHA. And if the borrower was like a lot of first-time home buyers that would just say, give me the lowest interest rate. That's all I care about. Just give me the lowest interest rate. That would backfire on them because the lowest interest rate would cause them to pay the most money over the first 10 years. So a lot of times, don't look at FHA as your go-to every time. Look at conventional, especially for people that have higher credit scores. There still will be some times where FHA is the better way to go, despite what I just said about it. With FHA, if the borrower has lower credit scores or if the property is a manufactured home, then FHA is probably going to be your go-to. But for anybody in the 700s who's not buying manufactured housing, probably FHA is going to be the better way for them to go in terms of saving them the most money on their financing. That makes sense? Anybody got any questions about that? Laura?
No questions at the moment.
Okay.
So manufactured housing is allowed under this?
Yes, on that, not on conventional, but on FHA, absolutely. We're probably the best source of manufactured housing financing in the entire state. Because we do it. And a lot of times lenders charge higher interest rates on manufactured housing than they do on non-manufactured housing, but we don't do that. So your borrower will do the loans, and we're going to treat interest rate wise, we're going to treat the borrower like they were getting a regular single family home. There's not going to be any extra add on to the rate for manufactured housing. Okay. All right, so the specialty programs. I mentioned to you when we were doing the 30,000 feet up in the air overview of why you're here, is that we have all these different specialty programs that act as solutions to the problems that for your first time home buyer that is preventing them from being able to get into a home. So you break that down into how they need help. They need help with their down payment and closing costs. They need help with having a lower mortgage payment. They need help with paying lower income taxes and getting greater refunds. And so we do all of those. And again, what's really cool is you don't have to pick one. Picking one would be cruel and unusual punishment. It would be like going to a birthday party and being told, do you want cake or ice cream? Nobody wants to make that choice. And no home buyer wants to have to make a choice between down payment assistance, mortgage, or a lower payment, or tax credits. They want all of it. And Virginia Housing's in a unique position where we can provide most home buyers all of those benefits on the same transaction. So let's talk about down payment assistance grant first. So down payment assistance grant, a lot of times we just refer to that as DPA grant. DPA stands for down payment assistance grant. Anytime you hear the word grant used when you're talking about a Virginia housing benefit, it's free money. There's no strings attached. There's no lien on the property. There's no interest being charged. There's no monthly payments being collected. And no matter how short a period of time the borrower may own the property, they don't have to pay the grant money back to Virginia Housing when they sell the house. It is totally free money. So the down payment assistance grant is going to be available for any loan that requires the borrower to make a down payment. And that would be FHA and conventional. FHA typically requires the borrower to put 3.5% down. Conventional, we require the borrower put 3% down. So what we do with the grant, consider it as a gift from Virginia Housing. We're going to provide this money to the borrower at closing on either program. And what it does for the borrower is it allows the borrower to get in for 1% down. So they have free equity right out of the gate. We're giving it to them. They're starting out with that. It's getting them for less money down, and they never have to give that money back to Virginia Housing. Okay. So we have another form of down payment assistance. It's another option. It's a choice that your loan officer will have to make. So the other form of down payment assistance is called a plus second mortgage. So the plus second mortgage is going to have a couple of advantages over the grant. First of all, if you remember, because there's a lot you're digesting here, the plus second loan is going to have higher income limits. So more people are going to be eligible to get the plus second loan than if they were trying to get the grant. The other advantage of the plus second loan is instead of lowering the down payment to 1%, which is already pretty cool, when you're doing the plus second loan and you're plugging that into the FHA or the conventional first, the borrower has to put no money down. So it's 0 money down instead of 1% down. And there's going to be a lot of advantages to that. So the borrower can, one other thing. So the borrower cannot get the grant and the second mortgage on the same transaction. Your lender is going to have to coach or counsel the borrower and help them decide which one is going to work the best for them. statistically, more people will benefit from the second mortgage, and I'll show you why in a second, than the free money on the grant. So the borrower can use the second mortgage behind any conventional first that we do or any FHA first that we do. And the way that the second mortgage works, again, let me annotate here. Look right here. So if the borrower has at least a 680 credit score, we will hold a second mortgage behind the first that will total 100% financing, and the borrower won't have to put any money down. So on a conventional loan, you could get a 97% first and a 3% second. On an FHA loan, it's 96.5% first and a 3.5% second. But the total in both cases is 100%, and the borrower doesn't have to put any money down. And the terms of the second mortgage are incredible, just so you'll know. The terms of the second are, it's a 30-year loan, it's fixed rate, and it has the same interest rate as the first mortgage. And a lot of times the payment on the second mortgage is going to be $50 a month, $65 a month, $70 a month. It's something very affordable. It's something very reasonable, especially when you see all the other benefits that the borrower is going to receive from using the second mortgage. So to be able to get a conventional or an FHA loan with no money down, that's already pretty sweet. That's why this is the most popular program that we have, but we can make it a little bit better still by looking at this column over here. Okay. All right. So if you look at that column over there, you see the numbers for the second mortgage have increased by 1.5%. The 3% second on a conventional went up to 4.5%. The 3.5% second on FHA went up to 5%. And so if the borrower has at least a 680 credit score, the borrower can increase the amount of their second mortgage by 1.5%. That's going to provide the borrower with no money down financing. And that extra 1.5% will create closing cost assistance to help the borrower too. So this is the one situation that your borrower can get both down payment and closing cost assistance on the same transaction. So if your sales price was $300,000 and you were doing this for a borrower with a 680 credit score, not only would the borrower get no money down, but they would have $4,500 to help them with closing costs. That was huge over the last couple of years because basically sellers wouldn't pay any closing costs and buyers needed that extra $4,500. So it's still available now. But now as the market is turning and sellers are starting to maybe loosen up a little bit and maybe they're willing to pay some closing costs, you can combine the seller closing costs with the closing costs from that second mortgage. And you truly can end up with a situation where the down payment and the closing cost is totally covered and the borrower doesn't have to put any money into the transaction. So if your loan officer can structure it this way, and that's based on what can you do with the seller in negotiating your contract, you could use the proceeds from that second mortgage for closing costs, get some additional closing costs from the seller in the contract, have everything be covered. And when the borrower goes to closing, where everybody's expecting that they have to bring money to closing, your borrower could actually walk away from closing with a check for $1,500. They could get all of their POC items back at closing if you can structure it this way. So if they put $500 down for earnest money deposit, $500 down for the appraisal, and $500 down for the home inspection, and you've got these closing costs covered both from the second mortgage and from the seller, all of that's covered, and the borrower goes to closing, doesn't need any money, and they walk away with a check for $1,500. That was my signature financing when I was a loan officer as recently as 5 years ago in Hampton Roads. And that makes a happy borrower. Does anybody have any questions in the audience? Or Laura, anybody have a question on the call?
Not at the moment.
Okay. Okay, we're going to shift gears a little bit to a different loan program that Virginia Housing offers, and that is VA loans and USDA loans. So VA loans are for veterans, USDA loans are for borrowers who are buying in rural areas. Both of those loan programs, we offer them. Both of them already provide the borrower with zero down financing. You don't need any help from us to get zero down financing on those loan types. So Virginia Housing will not provide down payment assistance on a loan that doesn't require a down payment. But we still want to be nice. We still want to help veterans. We still want to help borrowers in rural areas. So the way we help them is that we have a closing cost assistance grant that we provide on those loans. So a closing cost assistance grant says grant in the word, in the term. So grant means what? Free money. You don't have to pay it back ever. So you can align this on those loan programs, VA or USDA, and have no money down because that's what the financing did in the first place. But then the grant will be equal to 2% of the sales price. So you could get a VA loan for a veteran or a USDA loan for someone in a rural area and have no money down. And if the sales price was $300,000, Virginia Housing would give that borrower $6,000, no strings attached, that they could use to pay closing costs. They could use it to buy down the interest rate, which would help these days with the higher interest rates that we're having. Or another thing is on VA loans. VA loans allow the seller to pay off a debt for the veteran. That's the only type of loan that allows that. You could have the seller pay off a debt to help the borrower qualify, and then use the 2% closing cost grant from Virginia Housing to cover the closing costs. So if you're working with a great loan officer, they know all these things. And if they have the money that's made available to them through these different types of assistance that we have, then they can go to town and using the assistance in the best possible way to benefit the borrower and to help make the deal work for you and get that and to get the deal closed. Any questions? All right, so let's talk about mortgage credit certificates, or MCCs. Mortgage credit certificate is a tax break that Virginia Housing offers to all first-time homebuyers on every program that we do. They don't have to ask for it. There's no charge for it. It's absolutely free. We're just going to provide that to every first-time homebuyer on every program that we do. What it does is it's going to lower the federal income taxes for the borrower, and it's a tax credit, not a tax deduction. A tax credit is better than a tax deduction because it's going to give the borrower a dollar for dollar reduction on their bottom line federal income tax liability on page 2 of their 1040. A tax deduction just lowers the taxable income. The tax credit's better because it actually applies towards reducing the tax liability. And when you consider the withholding that the borrower had, it's going to give them a larger refund at tax time. So the way that this works is the borrower gets to take 10% of their mortgage interest that they paid in the previous year as a credit or as a dollar for dollar reduction against their bottom line tax liability. If the borrower paid $10,000 of mortgage interest last year and they're filing their taxes, that's going to equate into a $1,000 credit. It's going to lower their tax liability and it's going to increase their refund by $1,000. And then and they get to take that even if they're not itemizing. For mortgage interest to be deductible, you have to itemize. If you don't itemize, your mortgage interest doesn't have any benefit to you at all. But with this is even if you're taking the standard deduction and you can't itemize, you can still take this tax credit on that transaction. So this is going to become globally beneficial, even for, every taxpayer, even if they're itemizing, they get to take the tax credit. And it's not just for 1 year. It's not a one-off deal. The borrower gets to continue to take this year after year after year for up to the entire 30 years of the loan. There's only 2 things that will end the tax credit. One is that they pay off the loan. The other is they move out of the house and they turn it into rental property. But other than that, your borrower is going to get the tax break on this, for up to an entire 30 years. So we are offering this again on to every first-time home buyer. They don't even have to ask for it, on every program that we do, and it's absolutely free of charge. So people are leaving money on the table if they don't take advantage of this tax credit. We're offering it that way on our loans, but we also make this available to lenders on non-Virginia housing loans. So if the loan is not a Virginia housing loan and the borrower does meet our first-time home buyer rules and they meet our income and sales price limits, we'll still let the borrower take the tax credit. The only difference is the borrower does have to pay a $750 fee in that situation. It's treated as a closing cost. It would just be collected at closing and remitted to us after closing. But the borrower would get the benefit of that. I mean, that would be offset by their tax credit the first year, and then they would get to continue to get that break every year for the next 29 years following. So it's $750 in that situation, but don't walk away thinking $750 on every transaction. Again, if it's a Virginia housing loan, it's absolutely free of charge. It's only if your lender's not doing a Virginia housing loan, but they still want to provide the borrower with a tax credit, that we're charging a $750 fee on that transaction. All right, this is going to be the last specialty product that we talk about today. This is called Spark, and Spark stands for Sponsoring Partnerships and Revitalizing Communities. I have to say up front, this program here is a little different than all the other ones that we've talked about up till this point. All the other ones are pretty much globally available for every first-time home buyer on every program, on every house, and it's all part of just working with your lender. You can everything that we've talked about, your lender can give it to you as part of one singular process, one workflow, and one set of guidelines. Spark isn't going to be that way. Spark will require you to deal with another entity that I'll introduce you to in a second. But Spark is a special allocation of reduced interest rate funding that we make available to local governments and nonprofit organizations. So in Roanoke, you have a great business partner of ours called CERCAP. And borrowers who are working with CERCAP can get a 1% reduction on their interest rate to go along with all the other benefits that we've talked about today. Everybody knows CERCAP? Well, I'll show you a slide in a second with their contact information on it. CERCAP is a great organization in Roanoke. There was a lady named Deborah Duvall who was there. She just left, but they've replaced her. And there's a guy named Jacob, and he's doing a great job too. If your borrower works with CERCAP, among like 30 different organizations in the state that will do this, but CERCAP is the only one that I can recall that's in Roanoke, then your borrower gets, when they get a Virginia housing loan, they can get all the other down payment assistance, closing cost assistance, lower costing mortgage insurance, tax credits. And on top of all of that, we'll give the borrower a permanent free 1% reduction in their interest rate. So if the rate was going to be 7 on our regular rate sheet and our lenders were going to quote a 7% rate, then all of a sudden, because you're working with CERCAP, their borrower's interest rate would go down to 6%. And these days, every little bit helps with the way interest rates have gone up. We were doing this when rates were at 2.5%, people getting Spark, we closed loans at 1.5% for a 30-year fixed rate loan. That was really sweet. Maybe it's a little bit sweeter now, because if rates are at 7 and you can get it for 6, people might appreciate that even more. So I would just recommend to you, if you don't know CERCAP, if you've never heard of this before, I'd make arrangements to put them on your friend list. You know, you want to get to know them and direct people over to them so that they can go through their program and get that 1% reduction in their interest rate. So here's a list of all the Spark sponsors throughout the entire state. There's like 30 of them, and I'll give this presentation to Laura, and then Laura can share this with everybody after we're done. unfortunately, out of the 30 that there are, probably, well, there's one in Roanoke and there's at least one in Christiansburg. So there's Community Housing Partners in Christiansburg, which is Jake Powell is the executive director. And then you have SURCAP, which is the Southeast Rural Community Assistance Project. That's in Roanoke. Habitat for Humanity is also part of that. So there's different entities that you can work with. And if you know of any local governments or nonprofit organizations here in this area that are not participating in this, but they're dealing with affordable housing, please recommend them to me, introduce them to me, so that when we go through this process of allocating these funds next spring for the following year, maybe we can get Roanoke and this and the outlying areas additional places that can offer this money. Because other areas of Virginia have a lot more opportunity to get this 1% reduction in their rate. It really is not fair to Roanoke that you guys don't have more of this here. If you can help me line up more sponsor organizations that are involved in affordable housing, we can work together to rectify that situation and get more people that 1% reduction in their rate. So I would welcome any conversations that you can set me up with where we can do that. So that really concludes my comments today, my formal presentation. So having gone through what we've gone through, does anyone have any questions that they would like to ask? Yes.
Is it true that you're only allocated so much funding per year for these types of programs, so grants and things?
So in other words, might we run out of money?
Right.
That's a great question. And I can put your mind at ease.
Okay.
We never run out of money. We are in the market. We're in the market 365 days a year. I've been dealing with Virginia Housing either as an employee or as a loan officer for 40 years. And I cannot recall a time that Virginia Housing was ever out of the market. Now, I have heard on occasion that there's been, gossip and rumors, and people have said things that were not true about us, where, they've said, well, Virginia Housing's out of money. We can't do a Virginia Housing loan right now.
I've been told that before.
That's not true.
Okay.
Yeah, that's simply not true. So
You may have heard it's like USDA or rural housing, which you can do those programs for Virginia Housing. They run out of money, but for a very short period of time.
Okay,
Like maybe 30 days.
Okay.
And most of us, depending on your loan officer, will still continue to fund and do those loans knowing. So Frank, he's got deep pockets.
as we do. And I will tell you, back USDA fairly routinely will run out of money each year and be out of the market. And at that time, USDA will, but at that time, we become even a better friend to everyone, because if you can't get a USDA loan, a lot of people call us and shift the borrower into an FHA loan with a plus second loan or with down payment assistance, and we never run out of that money. But I have had realtors and lenders call me and say, so-and-so is telling me that you're out of business right now. You don't have any funding. You're not offering your regular programs right now. Is that true? I do hear that a couple times a year. And we are never out of the market. The only time we might not be able to do something is when USDA is out of the market. We couldn't do a USDA loan. But then a lot of times, again, people shift over to FHA and they get an FHA loan with the plus second, and they still get no money down financing.
I think it was more or less towards the grants and things
Right.
like that.
But we're in the market with grants and second mortgages and such 365 days a year. You can count on us to be there. You're in good hands with us.
And there's other grant options other than them that do run out of money. So when you hear DPA, down payment assistance, they're not the only option, and some of the other options do run out.
Okay.
So
Maybe that's what they were.
it can be very confusing, because if you're using their DPA, you don't have to worry about it if you're using it.
And one of the things that we're promoting right now in the cause of trying to make housing be more affordable is that we will let you pair up our down payment and closing cost assistance with other forms of assistance from other organizations. We allow it and we encourage it. So if there's a local government in this area, or if there's a nonprofit in this area where they are also offering their own assistance, you don't have to choose between them. You can get both. So that way, if there are multiple forms of assistance that are available here, we want the borrower to get the benefit of all of it. And so we, again, not only do we allow it, we encourage you to do that, to become aware of all the different resources that you may have in your own backyard already, and then pair that up with us. And then you can really, make a difference for your home buyer.
Good to know.
Anybody else have a question? Laura?
Nope, we don't have any questions. Thanks.
Okay, so the last thing I'll say two things. One is I gave you a form when you sat down, and if you will complete that form and turn it into me before you leave, we have a gift for you that we'll give you for free. On our website, virginiahousing.com, there's a lot of first-time home buyers that come to our website looking for our assistance. And we have a page on our website called Find a Real Estate Agent. And we've purged it recently because we had like 25 years worth of realtors on that page. And so there were many of them that not only were they not with the same company, they weren't in the same life. So we have purged it, and it's really a low number right now. And so we're trying to repopulate it. And now we're saying you have to take this class every 2 years to keep your name on that list. But since you've taken this class, if you'll fill out that form and give it to me when you leave, I'll add you to the website. If somebody is visiting our website and they say, you know what, this looks really great, I need a realtor that knows this stuff too, your name will be on there. And I can tell you, you'll be one of the few names that's on there. And so people will be channeled to you, and you'll have an opportunity to pick up leads and referrals from Virginia Housing because you took the time to take this class and you showed a concern for being our business partner. So we want to thank you for that. And that's one of the ways we thank you. And then the last thing I would say to you is, if you are surprised or impressed and you say, wow, why didn't I know about all this stuff? I've really missed the boat by not knowing about all this stuff when I'm working with my clients. Go back and tell your brokers about this. Go back and tell other agents in your office about this. And I will come out and do in your office training for all the agents in your office. And I will personally come and I'll buy lunch for all the agents in your office and provide this training and get everybody added to our website so that everybody can know this information. I know from being a loan officer for 35 years, if you want to get something done, enlist your realtors to help you. If we want people to know about what we're offering to help more people get into a home, we can talk to a lot of different people, but if we come and tell realtors about it, you guys will get the word out, and more people will get the benefit of this from you guys than from any other source. So I will come to your office. I'll buy lunch for everybody. I'll do this same training. I'll add everybody to the website. So please go back and talk it up and spread the word.
For the people who are online today, is there a way that they can complete a form or go online?
Yes.
Yeah.
Laura's got it
So
covered.
yeah, so I've shared that form with the association. And so anybody that took the training today and they didn't get the form handed to them already, it will be emailed to you. And if you will email it back to me, then again, I'll add your contact information to Find a Real Estate Agent on our website, and you'll get the benefit of some leads and some referrals. And we just want to thank everybody for taking the time out to be here. Yes.
Laura has a question on Zoom.
Yes, Laura?
That was the question. Everybody online is raising their hand. So you'll give me the form and VAR, we will send it to you and we'll get it back to Frank.
Yes.
Right, can I add one thing?
Please.
That, realtors are afraid of Virginia housing loans. Most realtors are. I don't want to say everyone. The only thing that I can add as a loan officer is just give it a little bit more time, because it does have, it's like having an 18-wheeler. You're still going to get there. We're going to get you to closing. But when we take the turns, they're a little bit wider, so we need a little bit more time to get around that turn or whatever. But, I mean, otherwise, I've been doing them for longer than, well, 20 years probably. They're great ones.
Yeah, and you, both of you have been great business partners. I really appreciate your collaborating with us.
About how long?
Well, we never recommend a 30-day closing,
Right.
no matter how slow the market is. We always say, give us 45 days. And if you've got the borrower to us at a pre-qual level ahead of time, we may even ask for a little bit more because we know that maybe they've got a little bit more complicated situation. It's not so much like your lender, it's your borrower has to get us a little bit more things. And we want to give them a pleasant experience to get those things instead of a panicked experience. So, but they're nothing unheard of, but it's not unusual. They have 2 jobs or 3 jobs that we have to go through verification of employment. And we're not, we and the borrower are relying on other people's. But that's one thing I ever recommend.
We're actually delegated underwriting and we can close ours fairly quick because our underwriters will just sign off. Yeah.
So,
It's pretty good.
so that, she just brought up a term that I'll define for you. She said, we're a delegated lender. So there's 2 different kinds of lenders with Virginia Housing. One is a delegated lender, the other is a non-delegated lender. So a non-delegated lender, their workflow with us is they originate the loan, they process the loan, they underwrite the loan as if they were the final say. But before they can close the loan, they have to submit the file to Virginia Housing. And then we do a second underwrite of it. And then when we've cleared it, it's cleared to close. Our turn time in most cases is 48 hours. So it's not like USDA is sometimes where you have to submit and it takes weeks. It's 48 hours and we can maintain 48-hour turn time on that pretty much throughout the entire year. It might slip to 72 hours at the height of the market.
Yeah.
4 hours.
Yeah,
It's been quick.
yeah.
I think I mean, and the underwriters that they do have, that if our underwriters need to go to for inspection, are answering things in 15 minutes,
Yeah.
Yeah.
So that's a non-delegated lender. A delegated lender does the exact same process. The only difference is when the delegated lender underwrites the file and they approve it, they're done. They don't have to submit it to us and you save that 48 hours. So there's no, really no difference than that. We have great partnerships with delegated and non-delegated lenders. Neither one is inherently better than the other, but that is something that will come up if you talk to one lender and they say, I have to submit the file to Virginia Housing as 48 hours, and the other lender says, oh, we don't have to do that. Now you kind of know why there's a difference in the 2.
Frank, will you talk about the estimated cost to finish any unfinished?
Sure.
footage? Because that always confuses the realtor.
Frank, can you repeat that question so Zoom
Yeah.
can hear it? please?
Yeah, so the question was raised, talking about the estimated cost of finishing a property and the impact that that has on the transaction. So when you go back to, let's see, when you go back to the sales price limit that we have of $330,000, I told you that there were 2 numbers that you had to check against that 330. And neither value could be more than 330 if you're going to proceed with a Virginia Housing loan. One was the sales price of the property. That's really easy. You just look at page 1 of your contract and your contract sales price cannot be more than 330. Easy. The second one was the loan amount. It's, that's less likely to impact you, but the total of your first and your second mortgage, especially when you're using that extra 1.5%, it could not exceed $330,000 either. Now, the third one that I have not told you about yet, because there's only so much I can cover in an hour and a half, and so I have to be discerning about what I'm going to talk about. I didn't mention this, but we do have a little bit of extra time and it got brought up, is there's something called acquisition cost. Now, acquisition cost has to do with if your property has unfinished areas that are suitable for being finished, you have to add the cost of finishing those areas to the sales price of the property to give you what we call acquisition cost. The acquisition cost also cannot exceed $330,000. So if you, let's say you had an unfinished basement that was 1,000 square feet, even if the borrower swears on a stack of Bibles or signs a stack of affidavits that I'm never going to finish my basement, you still have, the loan officer still has to do this calculation. You'd have to take 1,000 square feet. We'd multiply that times $15 a square foot. That's our internal calculation. And it would be $15,000 to finish the basement. So you'd have to add that $15,000 to the sales price. And that number, the acquisition cost cannot be more than $330,000. So if you're already approaching 330 on your sales price and you have 1,000 square foot basement, that's something you'd have to be mindful of. If you were under, you know, if the limit's 330 and the house is 200 or 250 or 275, you can't have a big enough basement where you're going to have a problem with this. But if you already are at 320 or 325 and there's going to be 1,000 square foot basement, then you have to be mindful of it, because if the sales price plus finishing that unfinished basement would put you over 330, you would not be eligible for Virginia housing financing.
Laura has a Zoom question.
Yes, Laura.
Yes, one of our attendees has asked, couldn't find the list of the loan officers on the website and was asking for some help. But then another Zoom attendee said, you go to individuals/families and then there's a drop box. So can you explain where they would go to find the loan officers on your site?
On our website, at the top, you're going to go to, I think it's individuals and families, and then you can check on home buyers, and then you'll go to the home buyer page, scroll down to the bottom of the home buyer page, and there's going to be quick links. One quick link would say find a real estate agent, which is what you're going to be signing up for. And the other one, it says find a lender, which is what your realtors are looking for right now. So go to the individuals and families, go to home buyers, scroll down to the bottom of the page, there'll be quick links, and there will be a find a real estate agent page that you can go to from quick links, and there'll be a find a lender page that you can go to from quick links also, and either one of them works there. And then when you're, especially when you're looking at the lender page, to help you with that, we have an award. We have annual awards that we give out to our top loan officers based on their productivity and their production. So you'll see medals next to many of their names. There's a platinum medal, a gold medal, a silver medal, and a bronze medal. If any loan officer there has a medal next to their name, that's just telling you that they do a lot of Virginia housing loans themselves. So if they have a bronze medal next to their name, they've done 20 loans in a year. If they have silver, they've done 30. If they have gold, they've done 40. If they've done platinum, they've done 50. So sometimes if you're working a Virginia housing loan and you do one Virginia housing loan a year as a loan officer, that increases the chances that something's going to get off track. There's a correlation there. If you're dealing with a loan officer who has done more loans, it's more, and they do more of their total business by doing Virginia housing, it is less likely that things will get off track. But it's a rule of thumb. It always happened with me. If you try to do a particular kind of transaction once a year, it's a better likelihood that it's going to mess up. When I try to do one 203K loan a year, it never worked out.
Oh, yeah.
So did that help, Laura?
Yes, thank you.
Anybody else have any questions? Yes, sir.
So on the lending question, that list, is it delegated and non-delegated, just those that have done Virginia housing loans?
We don't disclose on the list who's delegated and who's non-delegated. We do disclose who's got the awards, so bronze, silver, gold, platinum, but we don't disclose who is delegated and non-delegated. That's something you just have to basically ask the loan officer about that. It's a great ice-breaking question if you're looking for a new loan officer. And I want to emphasize that we have great relationships with both kinds of lenders. Non-delegated lenders do a lot of production, and you don't need to steer clear of them. They do a great job, just like the delegated lenders do. But if you ask the question, or if you're dealing with two lenders and one has to send loans to us and one doesn't, you need to understand the principles and know why that is.
I've worked for both. And as a loan officer, it was, I'm not gonna tell you what my preference was, but delegated did not add any value to me because the underwriter did not underwrite in this particular case. Company, 100 underwriters, and whoever landed on their desk may have not underwritten a Virginia housing loan for a year. So there's value, I would say, I would not, I don't know about you, but I don't know if you work for both. It just depends.
Yeah.
So I'd say it's more of the loan officer that's dealt with all of Virginia housing.
Yeah. Anybody else have any questions? Then I'll say one more time, thank you for coming. Turn in your sheet so that I can get you added to our Find a Realtor page. And if you found anything of value here today that you'd like to spread the word on this, go home, go to your office, tell your brokers, tell your fellow agents about this, and I will have them call me. We'll set something up. I will come and feed you. I will buy lunch for your office. And I will, and I'll come out and do this training. And because that's, again, I really believe this sincerely and fervently. If we want to impact home buyers and get more people into homes, I can talk to lenders all week long when I do. I can talk to nonprofit organizations all week long, and I do. But if I really want to deliver the message, and if I really want to be effective about it, I talk to realtors, because you guys are the ones that you drive the bus, and we know it. And so that's why we like to come out and talk to you guys. So if there's no other questions, then I guess, Laura, I guess we'll just finish up the training here.
Excuse me, I have a question, sir.
Okay, go ahead.
How can we have your contact information?
Everybody that's here, I have a business card, and I'll give it, and then I will give my business card to Jim, and Jim can also share this. He'll send it out to everybody with the form that you're going to be returning to me.
Thank you, I appreciate it.
I appreciate you guys. All right.
Thank you, Frank.
All right.
Thank you.